Right now, 78% of Bitcoin traders are wrong about this consolidation. I just looked at the positioning data from Binance, from Coinbase, from the CME, and 78% of all open positions are long. That means almost every trader out there is betting on this bounce to continue. They're betting that we are going to rally back to 80k, that this is just a minor dip before the next leg up. They see the small bounce off 76500, they see the Iran deal headlines, they see the social media posts saying by the dip, this is the last chance to get in before the ETF inflows pick back up, and they're loading up on longs thinking this is the bottom. But that's exactly the trap. Because when 78% of traders are on one side of the trade, that means the market is going to move the other way to liquidate all of them. That's how this market works. That's how you get those 10% moves in a single day, because all those stops get hit at once. And that's exactly what's setting up right now. But there is one danger zone and one hidden opportunity today. I'll show you both. Stay until the end. I'm giving out 3 exact entry and exit levels you can use right now. No guesswork, no vague analysis, just exact numbers you can plug into your trading platform today. Let's cut to the chase. This session is not the time to chase that 2% bounce we saw overnight. I know it looks tempting. I know you're scared of missing out if we rally, but trust me, chasing this bounce is how you get trapped in a losing position. The bias right now is fading the rally. We are range-bound with a clear downside tilt until we see a confirmed break above that 78,269 resistance. And let me be clear, the invalidation level for this entire bearish setup is 78,935. If we punch through that level in the next 24 hours, everything I'm about to tell you is wrong. We flip fully bullish, we are looking at a run back to 80k, and you need to be loading up on longs. But right now, that's not the base case. The probability of that happening right now is less than 20%, based on the positioning data, based on the momentum, based on the macro picture. So don't bet your account on that low probability outcome. Write this number down. If we break 76,062 today, the whole structure shifts, and we are looking at a quick drop to 75k before we even think about support. That's the line in the sand. Don't forget it. If you're long right now, that's your stop loss. If you're waiting to short, that's your trigger. That number is more important than any headline, any social media post, any analyst take you're going to see today. That's the level that the entire market is watching. And if you don't have that number marked on your chart right now, you're already behind. Now let's pull up the charts, starting from the top time frame so you can see the big picture, not just the noise on the 15-minute chart that's been driving all the retail traders crazy this week. A lot of you are staring at the 1-minute chart, seeing every little tick up, and thinking that means the rally is back. But you're missing the forest for the trees. Let's start with the weekly chart, because that's where the real trend is. First, the weekly chart. Right now, the weekly trend is neutral. That means we haven't broken the longer-term structure yet, but we are testing the lower end of this consolidation range that we've been stuck in for the past 6 weeks. Let's go back. We hit that all-time high of 78,935 back in April, then we pulled back to 75397, then we rallied back up to 78269, then we pulled back again. That's the range, 75397 to 78935. We've been stuck in that range for 6 weeks. That's the longest consolidation we've had since the start of the year. And what happens after a consolidation that long? Usually, a big breakout, or a big breakdown. And right now, all the signs are pointing to a breakdown. Wait, look at the volume on the weekly chart. The volume during the up weeks, the weeks where we tried to rally, it's dropping. The volume during the down weeks, it's picking up. That means sellers are more aggressive than buyers. That means when price goes down, people are selling. When price goes up, people are not buying. That's a bearish sign. And then the open interest on the weekly chart? It's dropping. That means traders are not opening new positions. They're closing their old ones. They're waiting on the sidelines. That means when the break happens, there's going to be a lot of people waiting to jump in, which is going to amplify the move. Now move down to the daily chart. This is where the action is right now. The daily trend is flashing a strong sell, and that's not some random indicator that I pulled out of thin air. That's the price action confirming it. We've made 3 lower highs in a row on the daily chart. First, 78935, then 78269, then 77459. That's a clear descending triangle pattern. That's one of the most reliable bearish patterns out there. That means sellers are pushing the highs lower and lower, while support is holding at 76062 for now. And when that support breaks, that's when you get that big breakdown move. That's exactly the pattern we saw back in March, right before we dropped 8,000 points in 5 days. That's the same exact pattern. Now look at the moving averages here, because they're telling the same story. The 5-day average is sitting at 77459. That's right above current price. We already broke below that yesterday. That means the short-term trend is already down. The 10-day average is at 78054. That was the top of this recent bounce. We couldn't even get back up to test that level overnight. That means the bounce was so weak, we couldn't even get back to the 10-day average. That's a sign of how weak the buyers are right now. Then the 20-day average? That's at 78329. That's the first major resistance we have above us. That's why that 78,269 resistance level lines up almost perfectly with that 20-day average. That's not a coincidence. That's where all the short-term sellers are waiting. That's the brick wall that's going to stop any rally dead in its tracks unless we have a massive flood of new buying power. We've tested that 20-day average 3 times in the past month, and every single time, we've bounced off it and dropped. That's 3 tests. That means it's only a matter of time before we give up and break lower. Now look at the longer-term daily Mars. The 50-day average is at 76526. Wait a second. Current price is 76,697. That means we are literally sitting 171 points above the 50-day average right now. That's the first line of defense for the bulls. That's the level that's been holding as support for the past month. Every time we've tested this 50-day average over the past 3 months, we've bounced off it. But this time, it's different. Because this time, the momentum is down. Before, when we tested the 50-day average, we had strong momentum, we had strong ETF inflows, we had strong macro sentiment. This time, we have none of that. That means this is the first time we are testing the 50-day average with bearish momentum. And that means it's probably going to break. Then the 100-day average is at 76,856. Wait, that's actually above current price? 76856 is higher than 76,697? Oh right, so we already broke below the 100-day average yesterday. That's a big deal. Because the 100-day average has been a dynamic support level for this entire uptrend since the start of the year. We haven't closed below the 100-day average since January. Not once. Until yesterday. That's the first warning sign that the short-term trend is shifting. That's the first crack in the bullish structure. And then the 200-day average? That's way up at 81869. We haven't even been close to that in months. That's the ultimate longer-term support, but we are nowhere near that right now. That's how far we've pulled back from the highs. That means if we break the 50-day average, the next support we have is way down at 70k, basically. There's nothing in between. That's how much downside we have if this break happens. Now let's talk about momentum, because that's where most traders are missing the warning signs. The RSI on the daily chart is sitting at 44.91. That's not oversold, not even close. That means we still have room to move lower before we hit that oversold territory that would trigger a bounce. A lot of traders are looking at this pullback and saying, oh, RSI is dropping, it's going to bounce soon, but no, 44 is neutral. We can drop all the way to 30 before we even get to oversold. That means there's no safety net here for bulls right now. There's nothing stopping us from dropping 2,000 points, 3,000 points, before we even get to the point where buyers step in. That's the danger. You think we are near a bounce, but we are not. We are just in the middle of the neutral zone. We can go a lot lower than the MACD. The MACD line is at 176.6 right now. Wait, that's still positive, but it's dropping fast. It's crossed below the signal line already, right? Because we have. That's strong sell signal. That means the momentum is shifting from bullish to bearish. We had the MACD cross over to the downside last week. That's the first bearish cross we've had since January. That's another big warning sign. Every time we've had that MACD cross on the daily chart over the past year, we've had a drop of at least 5% in the next 2 weeks. That's the track record. 8 out of 9 times, that's what happened. That's an 88% win rate for that signal. And that's exactly what we have right now. Move down to the 4-hour chart. That's where most active traders are operating. That's where we get the short-term signals. On the 4-hour, we have that strong sell trend, same as the daily. Look at the price action here. We've made lower highs, lower lows, for the past 3 days. That's a clear downtrend on the 4-hour chart. And look at the MACD here. We had a peak back when we hit 78K last week, and since then, we had that bounce overnight, right? Price bounced from 76,200 up to 76,700. That's the 2% bounce everyone is excited about. But the MACD on the 4-hour didn't even get back to the previous high. It couldn't even get back to the level it was at last week. That's negative divergence. That means buyers are exhausted. Look at this negative divergence on 4H. Price is trying to bounce, but the momentum can't keep up. That means this bounce is weak. It's just a pullback before the next leg down. That's exactly what we saw in the last consolidation back in April, right before we dropped 5,000 points in 3 days. Same exact divergence, same exact setup, and the volume on the 4-hour chart? The volume on the bounce? It's half of what it was on the drop yesterday. That means there's no buying pressure behind this bounce. It's just short covering, that's it. The shorts are covering their positions, taking profit. That's why price is bouncing a little bit. But there's no new buyers coming in. There's no institutional money buying this dip. That's why the volume is so low. That means once the short covering is done, price is going to drop again. That's exactly what's happening here. Now the support and resistance levels, let's get those clear, because these are the numbers you need to have on your chart. First, the immediate support we have right now is 76062. That's the low we hit yesterday. That's the level that if we break that, we are going straight to the next support at 75397. That's the next major floor. That's the low from 2 weeks ago. That's the level that if we break that, we are looking at a drop all the way to 72K before we find any real support. On the resistance side, first resistance is 78269. That's the high from this week. That lines up with that 20-day moving average we talked about. If we break that, the next resistance is 78935. That's the high from last week. That's the invalidation level we talked about earlier. If we get above that, we are back to testing 80K dot, and let's not forget the cross-asset link here, because Bitcoin doesn't move in a vacuum. As the risk asset shadow, Bitcoin is tracking the S&P 500 tick for tick right now. The correlation between BTC and the S&P is at 0.78 this week. That's the highest it's been all year. That means when the S&P moves, Bitcoin moves 1.5 times as much. That means when the S&P pulls back, Bitcoin pulls back harder. When the S&P rallies, Bitcoin rallies harder. Right now, the S&P is testing its own 50-day average, same as Bitcoin. And if the S&P breaks below that support, you can bet Bitcoin is going to break below its support too. We saw that yesterday. The S&P dropped 0.5%, Bitcoin dropped 1.2%. That's exactly the correlation we are talking about. We are also watching the funding rates on Bitcoin, because right now, funding rates are still slightly positive. That means longs are still paying fees to hold their positions. That means there's still a lot of weak long positions out there that are going to get liquidated if we break that 76,062 level. That's how we get those liquidity grabs, right? When we break support, all those stops get hit. We cascade down to the next level. That's exactly what we are setting up for right now. Right now, there's $1.2 billion in long positions between 76,000 and 75,000. All of those are going to get liquidated if we break 76062. That's going to add even more selling pressure. That's going to make the drop even faster. That's why we can drop 2,000 points in a single day, because all those liquidations happen at once. That's the danger for the longs, right? Now, they don't realize that if that level breaks, they're not just going to lose a little bit, they're going to get liquidated instantly. Now let's talk about the fundamentals, because the headlines are trying to fool you right now. Overnight, you saw the headline everywhere. Bitcoin rises above $76,500 as Iran deal hopes support risk sentiment. That's the headline everyone is seeing. That's why all the retail traders are piling into longs right now. They think that if there's a deal with Iran, that means geopolitical risk is gone, that means risk assets can rally, that means Bitcoin is going to the moon. But wait, that's only half the story. Let's dig into what that actually means, because most traders are not looking past the headline. First, the Iran deal hopes. If there's a deal with Iran, that means we are going to see more oil supply coming online, right? That means oil prices are going to drop. That means inflation is going to drop. Wait, you'd think that would be good for risk assets, right? But wait, no, because if inflation drops, that means the Fed can cut rates sooner? Wait, but the market is already pricing in 2 rate cuts this year. The market has already priced in that inflation is going to drop, that the Fed is going to cut rates. So if the Iran deal happens, that's already priced in. There's no new upside there. But if the Iran deal doesn't happen, that's the surprise. That's the downside. Because if the deal falls through, then we are right back to geopolitical risk. Oil prices spike, inflation spikes, the Fed has to hold rates higher for longer. That's bad for risk assets. That's bad for Bitcoin. That's the risk here. The headline says Iran deal hopes, but that's just hope. It's not done yet. There's no guarantee that deal is going to happen. And if it doesn't, we are right back to square one. That's the danger that most traders are missing right now. They're buying the hope, not the actual deal. That's how you get trapped in these bear market rallies. You buy the hope, then when the hope doesn't materialize, you get crushed, and here's what most traders miss. The macro pressure is still there, even if the Iran deal happens. The analysis we are seeing right now says that this consolidation is testing whether spot demand can outlast macro pressure. And right now, the spot demand is weakening. Fast. Wait, the spot ETF flows. Last week, we had $500 million in inflows into the spot Bitcoin ETFs. That was good. That was the demand we were seeing. The week before that, we had $700 million. This week, we've only had $120 million. That's a 76% drop in inflows in just 2 weeks. That means the institutional demand that was driving this rally earlier this year, it's drying up. They're not buying the dip anymore. They're waiting on the sidelines. Because they're waiting for the Fed's next move. They're waiting for the inflation data next week. Because right now, the macro picture is still uncertain. We had the CPI data last week that came in hotter than expected, right? Headline CPI was 3.5%. Core CPI was 3.8%, both higher than expected. That means inflation is stickier than the market thought. That means the Fed is not going to cut rates as soon as everyone hoped. That means the dollar is going to stay strong. And when the dollar is strong, that's bad for Bitcoin, same as it's bad for all the other risk assets, same as it's bad for gold, same as it's bad for oil. Wait, and let's go back to that cross-asset link with the S&P 500. Right now, the S&P 500 is seeing the exact same thing. The institutional inflows into equities are drying up too. The market is consolidating, waiting for the next catalyst. And Bitcoin, as the risk asset shadow, is just following right along. Because right now, there's no new catalyst for Bitcoin. The halving was already priced in months ago. Everyone knew the halving was coming. Everyone bought in advance. The spot ETFs are already here. The inflows are slowing down. There's no new big catalyst on the horizon for Bitcoin. The only thing driving price right now is macro sentiment. That's it. That's why Bitcoin is just tracking the S&P, tracking the dollar, tracking the yields. Because there's nothing else moving it now. What's our 1 to 2 week directional lean? Right now, the base case is downside. We expect to test that 75,397 support level within the next week, and if we break that, we are looking at 72K by the end of the month. That's the base case, that's the 70% probability outcome, based on all the data we have right now. But wait, what would invalidate that thesis? Two things. First, if we get a confirmed break above 78935, that invalidation level we talked about earlier. If we break that, that means the bulls are back in control. We are going to test 80K again. That changes everything. Second, if we see a sudden spike in spot ETF inflows, over $1 billion in a single day, that would mean institutional demand is back, that would mean the big players are buying the dip again. That would change the whole picture. But right now, that's not what we are seeing. Right now, we are seeing weak demand, weak momentum, and a lot of weak long positions that are about to get liquidated. Wait, and let's not forget the other cross-asset link here, gold and oil, because they're telling us the same story. Right now, gold is testing its own support level, same as Bitcoin. Because if the Iran deal goes through, oil prices drop, inflation drops, real yields drop, which would be good for gold, right? But gold isn't rallying. Gold is sitting at 2,330. It's not moving. That means the market doesn't believe the Iran deal is going to happen. That means the market is pricing in the risk that the deal falls through. That's the same risk we are talking about for Bitcoin. If the deal falls through, oil spikes, inflation spikes, rates go up, gold drops, Bitcoin drops. That's the cross-asset validation we are seeing right now. Both gold and Bitcoin are testing support. Both are showing weak momentum. Both are waiting for the same catalyst. That's not a coincidence. That's the market telling us that the downside risk is real. And let's talk about the positioning data, because that's another thing most traders miss. The CFTC COT data, that shows us the institutional positioning. Last week, the large speculators reduced their long positions in Bitcoin futures by 20%. That means the big players, the hedge funds, the institutions, they're selling their longs. They're getting out of the market. They're not buying the dip. They are selling. Meanwhile, the retail traders? They're increasing their long positions by 15%. That's exactly the divergence we see at the top. The institutions sell, the retail buys. Then the market drops, the retail gets crushed, the institutions buy back lower. That's exactly what's happening right now. That's the same exact pattern we saw back in November 2021, right before the big crash. The institutions sold, the retail bought, then the market dropped 77% in 6 months. That's the same pattern. Don't be the retail trader who buys what the institutions are selling. Most people will skip this, but this is where money is made. Keep watching. I know you've seen 100 technical analysis videos that just talk about the chart, but they never give you the exact setups, the exact levels, the exact plan you need to actually trade this. That's what we do here. We give you actionable stuff, not just theory. So pay attention, because these 3 strategies are going to work no matter what happens next. First up, strategy 1, the sniper. This is for the conservative traders, the ones who don't want to guess. They want to wait for confirmation before they enter a trade. No early entries, no catching falling knives, just clean, high probability setups. This is for the traders who have a smaller account, who can't afford to be wrong a lot, who want to wait for the sure thing before they put their money on the line. The exact trigger condition here is, we need a confirmed close below 76062 on the 4-hour chart. That means we don't enter on an intraday spike below that level. We wait for the full 4-hour candle to close below it. That confirms the break is real, not one of those fake-outs we've seen so many times in this consolidation range, where price dips below support for 10 minutes then rallies back up to trap all the early shorts. We don't want to be that guy. We've had 3 fake-outs in this range in the past month, right? We dipped below 76062 once in April. Then we rallied back 2,000 points in a day. That trapped all the early shorts. That's why we wait for the confirmation. We don't want to get caught in that. Now, once we get that close, we enter short at market, which right now would be around 76,000, give or take 20 points. That's our entry. Now, the stop loss for this trade is exactly 76,500. Wait, why that level? Because that's the high of the consolidation range we've been in for the past 24 hours. That's the high of this bounce. If we break back above that level after the break, that means the move down was a fake out, the entire setup is void. We exit immediately with a small loss, no questions asked. That's how we keep our risk tight on this conservative setup. We only risk 500 points, no more now. The targets. Target 1 is 75,397. That's the next key support level we talked about earlier. That's the low from 2 weeks ago. That's where we expect the first bounce to happen. The risk on this trade is 500 points, right? Entry at 76,000, stop at 76,500. That's 500 points of maximum risk. Target 1 gives us 603 points of profit. That's a 1.2 to 1 risk-reward ratio. That's a solid first target. You can take half your position off there, lock in some profit, and let the rest run. That way, you've already paid for the trade, you've got your risk back, and the rest of the position is free profit. That's the conservative way to do it. Then target 2 is 73,800. That's the next major support level after 75397. That's the low from the March pullback. If we break 75397, that's where we are heading next. That gives us 2,200 points of profit. That's a 4.4 to 1 risk-reward ratio. That's a home run for a conservative setup. No guesswork, just waiting for the confirmation. And what voids this setup entirely? If we don't get that 4-hour close below 76062 in the next 48 hours, if instead we rally back above 77,000, this setup is dead. We move on, no hard feelings. We don't force trades. We wait for the setup to come to us. That's the sniper way. Next up, strategy 2, the active trader. This is the standard setup for most of you, the ones who are trading this range actively, not waiting for the break, but trading the price action as it happens. This is for the traders who have a bit more experience, who are watching the market intraday, who want to take advantage of the pullbacks and the rallies to make profit while we are in this consolidation. The entry condition here is, we get a pullback to the 77,200 level, which lines up almost perfectly with the 5-day moving average we talked about earlier. That's the resistance level for this bounce. Right now, price is at 76697. We expect it to rally a little bit more overnight, test that 77,200 level. That's where the sellers are going to step in. That's the mean reversion entry, selling the top of the pullback, right before the next leg down. We've tested this level 3 times in the past 2 weeks, and every single time, we've bounced off it and dropped. That's the level where the sellers always step in. That's why this is such a high probability entry. Now, the stop loss placement here is exactly 77,800. Why? Because that's above the 10-day moving average. That's above the recent high of this bounce. If we break above that level, that means the rally is stronger than we thought. The setup is invalid, we get out. That's 600 points of risk, that's it. No more now. The targets. First target is 76062. That's the immediate support level. The risk here is 600 points, right? Entry at 77,200, stop at 77,800. That's 600 points of risk. Target 1 gives us 1138 points of profit. That's a 1.9 to 1 risk-reward ratio. That's amazing. That's almost 2 to 1. That's the kind of risk-reward that makes you money over time. You take half your position off there, lock in that profit, and then for the rest of the position, you use a trailing stop of 200 points once we hit target 1. That means as price moves lower, you move your stop up 200 points behind the price, so you lock in as much profit as possible, and you let the trade run as far as it can. That way, if we drop all the way to 75397, you capture that entire move, but if we bounce, you don't give back all your profit. That's the active trader way, maximizing profit while managing risk. That way, you don't leave money on the table, but you also don't give back your profit if the market turns. Wait, before we move to the third strategy, let's see how aligned we are. Type your BTC USD range for tomorrow in the comments now. I'm reading them. I want to see how many of you are seeing the same levels I am. Drop that number in the comments right now. Let's go. Are you expecting us to break 76,062? Or are we going to hold the range? Drop your range in the comments. I want to see it. And I'll reply to the top comments later today, so make sure you drop it now. Now, strategy 3, the aggressor. This is high risk, only for those who know how to lose small and manage risk aggressively. This is not for beginners. Do not try this if you're new to trading Bitcoin, because this is a counter to the consensus, and it can move fast. If you don't have the discipline to cut your losses quickly, do not do this. This is only for experienced traders who can handle the volatility. The entry condition here is, enter short right now, at current price, 76697. That's right, you don't wait for the pullback, you don't wait for the break, you enter right now, because you think the bounce is already over, the momentum is already turning, and we are about to drop. You don't want to wait for the pullback to 77,200, because you think we are not going to get there. You think we are going to drop right now. That's the aggressive play. Now, the stop loss here is tight, exactly 77200. That's right, only 503 points of risk. That's it. Because if we rally above that level, that means the bounce is stronger than we thought. This setup is wrong. We get out immediately, no holding and hoping, no averaging down, just take the small loss and move on. That's the key to aggressive trading. You have to have a tight stop. You can't let a small loss turn into a big one. Most aggressive traders lose money because they hold on to losing trades. They hope it comes back. But not you. You take the 500-point loss, and you move on to the next setup. That's how you win with aggressive trading. You have a lot of small losses, and a few big wins that make up for all of them. Now, the targets. Target 1 is 76,062. That's the immediate support. That gives you 635 points of profit. That's a 1.26 to 1 risk-reward ratio. You can take half off there. Lock in that profit, so you've already got your risk back. Then target 2 is 75,397. That's the next support. That gives you 1,300 points of profit. That's a 2.58 to 1 risk-reward ratio. That's a huge payout if this works, but you have to understand the risk here. If we rally instead, you lose 500 points. That's it, no more, no less. That's why I said this is only for those who know how to manage risk aggressively. You can't hold on to this trade if it goes against you. You have to cut it off immediately. Most traders can't do that. So if that's you, stick to the first 2 strategies. Never risk more than 1 to 2% per trade. No positions through high-impact news next week, like the CPI data. Stops are non-negotiable. Don't you dare enter any of these trades without a stop loss. That's how you blow up your account. Let's wrap this up, because I know you need to get to your charts. The one most critical level for the next session is 76,062. That's the line. That's the level that decides everything. If we break that, we drop. If we hold that, we range. That's the number you need to watch today. No exceptions. Now, tomorrow's focus? We've got the US jobless claims data. That's going to move the dollar. That's going to move the S&P. That's going to move Bitcoin. We are also watching the spot ETF flows, because if we see a big spike in inflows, that changes everything. We're going to break that down first thing tomorrow morning, so make sure you're subscribed. Now, if you want the full breakdown on the S&P 500 and the liquidity tide that's moving all risk assets right now, that video is live now. Check the end screen. Go watch that next, because that's the macro picture that's driving Bitcoin right now. You can't understand BTC without understanding the S&P. And if you want the breakdown on gold and how the Iran deal is moving inflation expectations, that video is up too. Go check that out after this. Now, smash like if this analysis gave you a clear plan today. No guesswork, just exact levels you can use. Subscribe and hit the bell, because we cover 8 key assets every single day. We give you these exact trade setups, these exact levels, every morning before the market opens, so you never miss an explosive move. I'll see you in the next one.